So at some point, interest rates rise. That's going to knock out all this value, the valuations that we've seen. To that point, I should point out that Rivian is indicated now to open 125. So talk about valuations. What do you think?
Alex and Guy, thank you for having me on the show. Of course, this market has given us a surprise after surprise after surprise, and valuations absolutely matter. And as much as the retail investors in the markets tend to ignore the issues that we're seeing, such as higher material costs, supply chain interruptions, higher labor costs, all of that eventually is going to translate into the earnings revisions, not to mention potential for higher taxes, higher inflation. This is the reality. And with that said, we see the consumer strongly supporting this market, and we think that this spending, strong consumer spending, is going to continue throughout the end of the holiday season. But the question is, what comes after? And as much as the retail investor is so worried about taking money off the table too soon, in our opinion, what they should be worried about is the excessive risk to their portfolios. And this is the perfect time to gravitate towards defensive plays, to take profit, and to be in the sectors that are strategically positioned towards this more volatile market that presents a lot of challenges.
Alex is going to chuckle and laugh at me now because I've been asking this question a lot, but I hear it a lot being asked by other people. Are you suggesting that you should not be fully invested at this point?
Guy, absolutely. This is precisely what we're suggesting, but not to be fully invested. We are suggesting that we shouldn't be invested in exactly the same sectors that are disproportionately up. And this is the perfect time to evaluate our investment portfolios, see what sectors performed well, take some gains off the table in sectors like S&P 500, like Russell 2000, like certain parts of technology, and pivot to sectors that are positioned to do well in the following years, like healthcare, for example, where there's a lot of pent-up demand due to COVID. We're going to see this for years. Like financials that are positively correlated to the higher interest rate environment. I mean, this is going to be a reality. Fed is about to start raising rates. We really like consumer staples. We're a little apprehensive about consumer goods, but we still like consumer services. So the point is, there's still a way to make money in this market. It's okay to be fully invested, but we should be doing it in a very smart, strategic way.
Guy, I knew you were going to ask that question next. I think the mind meld today is complete. So, Katerina, Citi had an interesting call out the other day, saying that they're actually positioning for a decline in inflation. Like they see the peak coming, say, in the next 3 to 6 months, and they want to position for a decline in inflation. Does your thesis encapsulate that, or does it wrap in higher, more sustained inflation?
Alex, it's an interesting time when it comes to inflation. Federal Reserve, for example, views it as perhaps transitory in nature. But in our opinion, we should consider the fact that higher inflation is perhaps here to stay, both higher inflation and higher taxes. What we see right now is the increase in cost supported by higher demand. But we can't ignore the fact that it is also fueled by stimulus checks, by the fact that people had more money to spend because of the performance in the market and in the cryptocurrency. And going into the new year, is this trend going to continue? To come back to inflation, we actually think that inflation levels are going to be higher, and perhaps they're here to stay.
Do you think wages keep up with inflation? Your comments on the consumer being fairly healthy at the moment, it's certainly borne out by the data, but there is a gap currently between wages and inflation. There is a squeeze on the consumer. Does that become a bigger problem next year? And if so, how does that work its way back into the market?
Guy, it certainly is a data to watch, and the labor market is really challenging right now. We are on one side are seeing labor shortages and then pressures on wages, but what we are also concerned about is the decreased saving rates in this country. And we always say in almost every narrative that consumers are the driving force behind our economy. And as we're seeing this rates of savings declining, this is something that could present a challenge, absolutely.
I just want to point out we're getting another read now on Rivian, indicated to open at 120. So it really does feel like we're bouncing around this 120, 125 level. Remember, that stock priced at around $78 a share. Katerina, where does this leave your view on technology stocks, like the big tech names, where if you haven't owned them, you've just gotten really beaten up and you can't seem to beat your benchmark, really? What do you do?
Alex, we're not ready to give up on technology yet. The most exciting part about the world of technology is research and innovation and how much investment is being made into this technological development. So we think that this is the time to be really selective about the technology plays. And technology absolutely should remain within the investment portfolios, but competitive positioning of select technology companies or sectors that we have in our portfolios are more important than ever. We have to evaluate the portfolios. And again, we're huge proponents of profit taking. This is the time where if you see the disproportional growth in certain sectors of technology, in our portfolios, this is the time to not abandon that sector, but to strategically take profit and reallocate to the parts of technology, that sector that are going to continue to grow. And there is tremendous amount of opportunity there. And we think money is absolutely to be made in technology.
Where does that leave the headline index? I heard what you said about the S&P. I heard what you said about the Russell. As we get this rotation, does the index level come down?
Guy, there is a time for investing in indexes, and then there is a time where the active management and very careful security selection takes place. And this is the time for quality. This is the time for de-risking and strategic positioning. So when we look at the positioning of this sectors within the portfolio, we have to ask ourselves, is there a competitive advantage? Is there a the price sensitivity, right? That these companies can take advantage of, or is it something that is disproportionately positions them to not make a lot of profit next year? This is the time for all these questions. So we believe that this is not ideal time for index investing, but instead rotation to quality and individual security selection, would work much better in this market.